Hi, it's Brad from Ocean Consulting Services, and today's video will talk about offers in compromise. Can I really pay the IRS less than I owe? Okay, some highlights. The filing of the tax return begins this whole process. When the IRS receives your return, they enter it into their records. That becomes the assessment date. If you have a tax due, they'll send you a notice. If you don't pay the notice, typically within 10 days, they'll begin collection activities. So the collection activities can continue generally for a 10-year period. It's called the statute of limitations. So the IRS has a 10-year statutory period to collect the tax from you. What is an offer in compromise? It's called an OIC. They allow for a reduction in the amount of tax that's owed. So a lot of clients will come in and say, is it true the IRS will actually accept less than I owe for my taxes? The short answer is yes, but can I demonstrate to the IRS that I don't have enough in the way of current assets and future income to pay off the tax before the statute of limitation expires? If that's the case, then potentially an offer can be made to settle the debt for less than is owed. What are the requirements of an offer in compromise? First and foremost is what the IRS calls compliance. What that means is that you need to have returns, at least 6 returns the past 6 years on file with the IRS, completed and filed. Of course, payment does not have to be made, but at least filing the returns. And you also have to demonstrate that you're actually paying towards the current year. So they'll want to see that you have withholding being made. If you're being paid by wages, if you're self-employed, you're paying estimated taxes. Now, once they determine compliance, they'll look at what they consider, it's called an RCP, which is reasonable collection potential. That uses specific IRS rules to look at your assets and to look at your future income. And they'll also look at the statute of limitations. Let's talk a little bit about the RCP, the reasonable collection potential. It's a cash flow analysis. People get confused and talk about taxable income. That is not what this is. The IRS doesn't really concern themselves at this point when settling a tax debt about what's taxable, what's non-taxable. For example, you could have Social Security that may not be taxable, but it's still considered in the RCP computation. So it's important to remember, even though you're dealing with the IRS, this is not using normal income tax rules. In fact, there are specific rules regarding how to calculate a value of assets. You typically are allowed a reduction of 20%, the true value, to allow for what they consider to be a quick sale value. When it comes to your income, you're really taking, again, gross income from all sources. Doesn't matter if it's taxable or not. The expense side really can be a mix of your actual expenses, the IRS allowable expenses. They publish both federal and local guidelines that they may consider. Sometimes it's a mix of both. It's the lower of the actual or the allowable. So the big question, the biggest question usually relates to living expenses, to housing expenses, to rent expenses, and typically the IRS allowable amounts are less than the actual that a taxpayer pays. So the IRS, in computing the RCP, will only allow for the standard rate. So I frequently get a question of, well, does the IRS expect me to, move to another apartment? Do they expect me to sell my house and have a less of a mortgage payment? And the answer is no, they don't. This is just merely used to calculate how much they think they can settle the debt for. How you actually come up with the money to make the payment to settle your debt is irrelevant to the IRS. All right, so some basics in the computation of the offer amount. First step that I have all my clients do is really list all their assets, all their debts, and their current income and expenses. And again, not considering tax rules, this is really cash flow analysis. And then I compute the RCP, look at the SOL, the statute of limitations, and determine, is the reasonable collection potential enough to pay the entire tax debt? That's the first thing the IRS will look at. How much time is left on the statute and how much can they reasonably expect to get from selling assets and from taking a portion of your future income after an allowance for expenses. If the answer to that question is there is not enough, then they'll consider an offer. If there is enough future income and equity and assets, won't compromise the debt, although you can take advantage of some other programs, notably the installment agreement, which would allow you to pay off that liability over a period of time. What are the types of offers? Well, there's two main types of offers: lump sum and periodic payments. Lump sum is the total settled amount of the tax debt is due within 5 months. Now, they compute the settled amount to be your net equity and assets plus 12 months worth of future income as computed under the RCP guidelines. The requirement is that you submit 20% of that total with the offer, and once it's accepted, within 5 months you make payment of the entire amount. The other is called a periodic payment offer, and in this offer the amount computed is again the net equity in your assets, but this time it uses 24 months of future income and not 12, and they allow it to be paid over a period not to exceed 24 months. They do require you to begin making payments on a monthly basis when you submit the offer, although there are balloon payments allowed so you can minimize the amount of cash due up front with the monthly payments. A couple of related issues relating to offers. One is called dissipated assets. This sometimes catches people off guard. The IRS will look back 3 years and say, did you make payments, voluntary payments, that were to creditors who were behind the IRS in terms of seniority? So a typical example would be, you borrow money from a family member, the IRS debt arises, and then you decide to pay off that family member. The IRS will look at that and say, well, you could have used that money to pay us, therefore we're going to put it back into the computation. So again, they go back 3 years, they'll take a look at tax returns to see if anything, sold assets, generated revenue, and maybe paid it to someone who was behind the line in terms of seniority of the debt. The other thing is non-cash expenses are not deductible in computing RCP, the typical one being for a business depreciation expense. The other relates to income averaging. If you're having a particularly bad year, you can't necessarily rely on that. They will look back 3 years, and if your income was significantly more in the past years, they may require you to average your income to come up with the RCP amount. So in summary, the program, the OIC, can provide significant benefits. The IRS wants to settle debts. They want to make collections. That's their goal, is to collect on tax debts. Their goal is not to seize your assets. They don't want to own your house. They don't want to garnish your wages. They'll, believe me, they will rely on those items if you don't work with them, but they would rather compromise a debt than be in the position of needing to try to enforce collection. One thing to remember is that the OIC program has very specific rules, as I mentioned before. They mandate what you need to consider in terms of assets, what you need to consider in terms of your future income, and your future expenses. And sometimes those expenses, for example, may not be realistic to what you're actually spending. But again, that's pretty much irrelevant. The IRS is looking at this as they have the legally enforceable right to collect the entire amount of the tax debt. And for them to compromise, for them to take less than that amount, you need to comply with their rules. If you don't, and they don't accept the offer, then they can go back to forced collection, which could include, for example, garnishing wages, seizing bank account assets, or even seizing real estate. So it's important to recognize that fact that you do need to fall within their specific rules, whether or not they make sense to you personally, to determine whether you qualify for an offer. Next up, we'll have a video and related discussion on the actual computation of the RCP. Thanks for watching, and as always, feel free to reach out to us if you needed any help in your particular circumstance. Thanks, bye.